All right. Good morning, everybody. It's Friday. We made it. Um, Bonds and yields are making some moves. The 20-year yields closed down 0.84%, while the 10 and 30-year yields closed up 2% and 0.8%, which got me looking at the Fed fund curve, and there is no cuts being projected into the market until March of 2027. So all we've got is hikes projected from April to March of next year. Here's March, and you can see, now where'd it go? Maybe it was a little farther out. There it is. Past March, we get into April. There's our first projected cut. So they unwound all of those and are pricing in hikes. There was also a headline last night that Japan is paying $150 to $200 a barrel for energy. And there was projections from one of the big firms that suggests we could see crude hitting 200 or 250 by the June-July timeframe if the strait does not get opened soon. So all of this, the clock is ticking. It's coming to a head very soon. Now there is a time frame for any sort of resolution or solution as troop buildup, deployment, moving everybody over there, getting into position. It takes time, and we're looking at a couple of weeks. So unless diplomacy kicks in a little sooner than that, it's likely we don't see a resolution to all of this for at least a few weeks out. Markets didn't like any of that. Japan down more than 2%, Hong Kong down 1%, and the US markets were down not even really more than 0.5%, but we are down this morning. We're going to get some data at 10 a.m., and then we've got Fed speakers through the rest of the day. It only lists 2 here, but if we come over and look at finance juice, there's more, right? And we've got European central bankers adding to it, also chipping their teeth. So we've just got a lot going on this morning. It's not an 8:30 economic calendar print, by the way. It's a 10 a.m. print, and that's going to screw up the logic that I've always used. The one that says if we haven't broke out by 10 a.m., we won't until after lunch. We kind of set that one aside on days where we get data at 10 a.m. Now, this one's only the consumer sentiment index, but still, you want to put that on the radar. It's very likely going to screw up any of the morning plays, especially if it's muddy water and we just don't get any guidance out of it. To commemorate the 250-year anniversary, I've heard that the current president will have his signature added to the $1 bill. Do with that as you will. All right, now we've been talking about the volatility control funds and how they're holding on and they really haven't started selling until they started selling. They are beginning to de-risk. That's one way of saying it. So the CTAs continue to be big sellers. We can see that in this chart. And vol targeting funds are starting to de-risk. We can see that in this chart. If you remember, we looked at these the other day, and this white line was not yet below that pivot. But if we was to snap a line on there now, we broke that level. Now, of course, if I snapped 111 and 123 onto that, we could anticipate a reversal or a bit of a pause there, maybe a lift back up under a Busby style behavior. So this might not just fall right out, but anticipate that we could get a little bit of a bounce, very much like we did back here when it broke this pivot. We went lower, likely into a 111 or a 1236, and then we rallied from that, right? If we measured from here to there, pull back to 786, break down into 111, 1236. If you know what I'm talking about because you've been there, then you know, and if you don't, well, you're missing out. You need to learn how we run those levels. And yeah, the um, ceasefire against energy facilities has been extended. It's not a blanket ceasefire, it's just a call to not hit energy facilities. Here's that headline about Japanese companies are buying oil at an average of $140 to $200 a barrel. They're going to feel that. Looking at the risk coming out of the White House this morning, we're sitting at a really low score. Now that can change, if someone engages him in conversation near reporters, if reporters start asking him questions, maybe if he just gets a few free minutes and jumps on social media. But it's not going to be part of any scheduled event. So watch for gotcha headlines, something that just, pops out of the blue, but there's nothing on the calendar. $142,000 in the overnight volume. The average is around 50 or 55,000, so we're still hitting well above average at this point. Call wall and put wall remain in place. All that changed is the other levels in between. If you go to the Spot Gamma website, they've got a free FAQ section that explains and talks about these various levels, which is pretty cool. It's helpful. And one of the interesting things that it talks about is how the big named levels, like the put wall, the call wall, zero gamma, volatility trigger, we're not usually interacting with those, right? They're usually outside the range of how far we could move on a day-to-day basis. But we do interact with the non named levels a lot more. So while it's easier to keep track of the named ones, and they are certainly more popular, the ones that you really want to watch when I post these levels every day are the other levels. You're basically just looking at which ones are we most likely to hit today. And, the ones that are within yesterday's trading range and or on the edges of yesterday's range are going to be the ones that we're most likely to interact with, since we're going to pick up where we left off and either break out of yesterday's range higher or lower, like we did this morning. Yesterday's low, inside day breakout of yesterday's low to the downside, reversal very close to the 1236. We got the OCC. We are done with yesterday's levels. Now you could keep this 1236 in case we go down there more, because we got near it. We didn't actually tag it, right? Close is close enough. So you could keep that level just to see if we're going to interact with it should we continue to go lower. But for the most part, we're done with it, right? Once we've interacted with those levels, we take them off, and instead we focus on today's levels. And what we've got at the moment is our own Globex range. 786 is the pullback level that we're dealing with right now. It's the idea that, price makes its move, pulls back. How far is the pullback going to be? Usually around 786. If that is the case, and then we continue on, where's the next leg lower going to go before it pauses or stops? 1, 2, 3, 6. Simple enough. If we break this low and it's a fake break, we're likely going to tangle up around that 111 and then begin our move back up. If we backed everything up to earlier when it was here, it was the same thing, right? Reversal stalled out around 786, dropped down to the 1236. That's where we paused. That's where we would have updated the drawing. That put us into this situation. That's why I was using that as the drawing location. Simple and effective. It works. So 65.28 is the midpoint for the Globex range right now, unless we finish this pullback and continue the move to the downside. We'll just keep running it level by level all the way down. What we want to keep track of is Monday's price. That big bar is the bar of control. And then while we're at it, we want to keep track of where that big bar started, right? Because it's a bit of a liquidity gap. All right, so we're through the liquidity gap. We're done with it. We really don't need that one anymore. What we still have is Monday's low, 64.83.5. We break that. We got some levels down here to deal with, but we're still running 50s. So if we break 6,500, we're still looking at 64.50. We cut that, then we're looking at 6,400. You get the idea. On and on, down and down we go. So far, everything's been very organized and controlled. We're not seeing fear out there, right? Just systematic, level by level, organized selling. At some point, if the markets get spooked, we're going to lose this organized, centralized selling structure, and things are just going to get really nasty really fast. Remember, markets crash from oversold levels, by the way. So there's that too. Now, we use the 10 to define whether or not we're even oversold to begin with. And looking at where we've been so far on the week with the 10, we're not there yet, but we're getting close. One thing to consider with where we're at now this morning is that everything that's happened since Monday morning has been erased. So the exuberance, trying to hold on, repricing, capital rotation, all of it, it all got unwound, and it's like we're right back to where we were Monday morning with that consistent, persistent decline that started back here on the 18th. Now, what that does give us is this continuation that we've been working on. So that Monday pop gave us a lower high. Even if we want to read it through Tuesday and Wednesday and just not even use Monday at all, we still got that lower high. So now we're looking for the lower low, and how low is it going to go? I'm sure there's a song in there somewhere. $64.73 is the ADR half. That's going to be lower than the Monday low that we're already focused on. And we're not there yet. Once we get there, we'll have to see how we got there. Did we just, drop down in a single shot, or did we continue to work our way down in a neat and organized manner? Really, a lot of that is going to be likely how we turn or how we respond when we do get there. Basic technical analysis would teach that you can measure that distance right there and then take that level and apply it to the highest point of the pullback to see if the next leg lower is larger than that leg or not. If it is, like this one is, then it shows that the acceleration to the downside is increasing. If it was equal or smaller, then it would show that the move lower was decreasing. You can, of course, measure the second time and apply it to the highest point of the pullback to see if the next leg lower is equal to or greater or smaller, to show if the move is still accelerating or if it's slowing down. That's old school, been around for a long time. Most candle textbooks will cover that, measuring the strength of the trend. It's a tactic worth picking up if you haven't used it before. And on the other side of that, of course, you can measure the pullbacks, how far they go, and whether they are getting smaller or larger, right? The pullbacks is where people are taking profit from the move, and other people are getting in to participate in a new move. If the move is going well, people should want to pile in and participate in the move. So we shouldn't get much of a pullback before others use that pullback as an entry point. When we get longer pullbacks, it shows a lack of participation or not as much enthusiasm for the move. More people are taking profit and exiting the trade, and less people are aggressively hopping into the trade to continue the move. So both of those, the leg lower and the pullback, can be measured to give us insight in the move that's taking place. Everything right now still indicates that we've got a lower target down here that makes a lot of sense. So unless we get through the 786 and start pushing back towards the half, we want to continue to target this lower level. We get through that, then we'll target the next level lower. And on and on and on. We almost had an MDP yesterday, especially since we kind of just barely wicked into it, didn't even close above it. We did actually hit it, didn't we? Let's get in there really, really close. You know what? We did not hit it. So that's an MDP from yesterday, missed daily pivot. So far today, we've got a second missed daily pivot. Nope, we hit it. So this one's done. We only had one. But we are heavy below that level. We wicked into it, barely closed above it, wasn't able to keep it, checked it again, wasn't able to maintain it, and down we went. So a 1 day missed daily pivot. Today's floor pivot lower than yesterday. That's bearish. Price opened underneath it. That's also bearish. Now we've began the expansion even deeper, and we're below the weekly, and that's also bearish. With the range that we've had in the last few days, it's likely that our S&R levels aren't really too wide, but take a look at what we've got. We're not quite to the S1 level yet. Now, there is a market phrase that says, if S1, then R2. That would be way up here. Actually, R1 is buried in that level right there, so here's R2, 66.95. S1, R2. That's the same idea of going from the lower ADR to the upper ADR. But we have to get there first. We're not at S1, and we haven't made it to the lower ADR yet. And usually, that sort of logic about going from an S1 to an R2 would be more about a market that's bottoming and maybe turning around to go the other direction, especially after an extended move down, and is now beginning to work back the other way. I mean, we're at the lows of all of this, but so far we don't have any turning around structure. And from a Friday standpoint, I would really like to end the week near or even inside of that Monday candle and then gap down on the following Monday, right? I'd really like a gap down Monday next week. If we could just stay inside this box, gap down into Monday, and then get one of those really big pen bars and rip it back the other direction and we run it up. That would be pretty good. But I don't think they're going to give us such a beautiful setup. Instead, I kind of got this sneaky suspicion they're going to wash us out on Friday. And it's going to get really ugly. So we'll see. A pin bar Friday is not, there's not a lot of those. And usually they're from shock and awe headlines and not something that was more organized in the chart. So we are near S1. Let's get there and see if we hold above it or not. If we do break below S1, then of course we got S2 below. We'll target that 64.32, and we'll just continue to target lower levels and play whichever direction we get. The base case for today is that we hold the line and we close inside of Monday's candle. Now we might get outside of it. Certainly, wick below it, get into that 111 or something. But base case, we close the week inside that bar. I believe the weekly expected move range for the week on the low end was like 64.30 something. We're going to see it in a few minutes when we get over to that chart, but we're still within the weekly range. All right, well, took a look at what's back there. I don't see anything that's really going to help us out. On the week, we've got a relatively decent distribution. 65.80 is where all of that starts. So if we do run back up and get through 65.50, then we've got this pivot to work through, and then we're back inside this value area for the week. We would have to get back above 6,600 to begin magnetizing into that point of control, and there's just not enough time left this week to really be concerned about it. So unless we get some kind of really bullish macro shock that sends us up to deal with that kind of level, I don't even see that on the table for today. What we're looking at here is the cumulative volume index. I have it set to the NASDAQ because you don't get a lot of choices on Thinkorswim. If you're using the cumulative volume on TradingView, you have more choices, including all. I really like the all choice, right? So you can look at all indexes combined. So I set this one to the NASDAQ since tech is so heavy weight anyways. And it's net buying versus net selling, generically speaking, right? So when it's pointing down, sellers over buyers, and when it's pointed up, buyers over sellers. Pretty simple. We're expanding that Bollinger out. The yellow line here, kind of a tannish line, that's the indicator itself. I applied Bollingers to it just to have standard deviation levels. And then these are just moving averages. So we're underneath all the averages. We're fanning it out. We're stretching the bands so the standard deviation is increasing. And it's negative, right? It's down off the highs. You would think that wouldn't be surprising, but if you've been keeping track of the cumulative volume index, especially the one on the NASDAQ, you'd see that we've been divergent for a while. It's been holding its highs even while the NASDAQ had been selling off. So behind the scenes, they weren't selling into that NASDAQ move. They were holding on. Were is the key word. But that is the TradingView version, and here we can see the selling's been since late January. Still, we're setting lower lows, lower highs, and the next level of some real help is a long ways off. So if we start to see more selling, it's got room. 10-day, 30-minute volume profile and TPO point of controls are a long ways off on both of these. No real help with the value area either, and we're at the bottom of the zone. So, of course, if we break down from here, we're going to expand this chart considerably. My base case, though, for today is that we're not really going to expand it all that much to the downside, and we're going to just hold the line into the close. We have a new VPOC from yesterday. We're stacking these up overhead. All of this is going to be drama to the upside when we finally do start making our way back up there. And we will eventually, right? It's not like the market's never going up again. So you can see the clusters. We're going to have to work through every one of those levels on the way back up if we try to make a move up today. We filled out this one. It's where our point of control is today, 65.50. So nothing's changed, right? Today looks a lot like yesterday. The structure, the organization, the level, the cleanness of the moves. They've activated their sell side programs and they're running them like butter at this point. All right, it's Friday, so we have next week's levels. Now, these levels are a projection, they're not locked in place yet. Throughout the day today, the gray line, which is marking where price is right now, it's going to continue to move with price up and down. And the green and red line are going to expand and contract based on the trading activity for next Friday's expiration. These levels are defined by that trade activity and the volatility within that expected expiration. So come over here for a second. Next week's levels. That's Thursday. Should be a Friday on there. Got the holiday next week. Yeah, we must have a holiday next week. What is that holiday? It's not Easter. Good Friday, April 3rd. Market will be closed. That one snuck up on me. I've been so busy digging into bonds and crude. That one snuck right past. All right, whatever. So that's what we're focused on, April 2nd. It's going to use that implied volatility. You can see the plus and minus right there, 195.62. We'll round that up to 196. That's one side, all right? So basically 200 points up, 200 points down. This number is an implied volatility average of all the out of the money options on the call side and the put side. Now you can see the implied vol. Every option strike has its own implied vol level. That implied volatility goes up or goes down based on how much trading activity that strike gets through the day. So if they're coming in and they're hitting it hard and fast at the ask and above, that's going to increase the implied vol, right? That's kind of the idea behind it. So their trading activity into next Thursday's expiration is what's expanding and contracting those levels. After the close today, it's going to lock into place and then it won't move anymore like all of these old lines when we look in the past. They don't move. They're locked into place. So after today, so will this. On Friday, what I like to look at is what the preview is showing us for next week. Are they expecting a lot of volatility? Are they expecting next week to be a bit of a hurry up and wait mode? What's the market considering for next week? Oddly enough, if it's a really narrow range, that usually implies the market is looking at the calendar and is concerned about something. FOMC, CPI, PPI, non-farm payroll, something like that. And that narrow range is showing that those economic events are volatility suppressing and that the market expects that we'll go sideways a day or two into that big event. So wide ranges imply something that isn't on the calendar. Inventories, energy crisis, some other thing that the market sees as a threat or that could elevate volatility, but isn't a part of the economic calendar. So far, next week's range looks a lot like the week that we just had. The problem with that, when we look at it and we say, oh, the volatility must not be that much different, it's only a little greater than the week that we just had, is that there's two pieces of math that go into this range. One of them is the volatility that I just showed you, and the other is the square root of time. How many days are in the week? The week that we just had, it's a 5-day week. Next week is a 4-day week, and yet next week has more volatility than the week that we just had. It doesn't look like much volatility when we look at this, right? It's only a little bit more, but when we consider that next week's a 4-day week, that's a lot more volatility. It's kind of like saying that you can travel 60 miles in an hour, or you can travel 60 miles in 45 minutes. Well, if you go 60 miles in 45 minutes, you had to go at a lot faster speed than if you did 60 miles in an hour. So we have more volatility next week, and it's not economic volatility based on the calendar. It's the market pricing in some sort of shock and awe, what we call unknown rather than known unknowns. A known unknown would be CPI, PPI, non-farm payrolls, one of those. We know something's coming, but we don't know what the outcome will be. These unknown unknowns is we don't know what's coming, we don't know what the outcome's going to be, but we're worried that something's coming, and then we're pricing in volatility. And that's what we're seeing. Continue to watch that level through the day today and see how much greater it expands. On Monday, we're going to reevaluate this level and see what we ended up with. It'll give us insight into what to expect for next week. A lot of breakout failures where we come back in, or breakouts that expand, inside day breakouts where we continue to run through the day. We are 2% below the 10-day moving average. Markets crash from oversold levels, and we are close to being oversold. We're not oversold, but we're really close to it. Minus 2% is just about as far as you want to go. 2.5 will be pretty much the line in the sand. If we get below the 10-day by more than 2.5%, I'm going to consider that oversold. And we can crash, not will. That's not the language we use. We can crash from oversold levels. And we're very close to being oversold. If you look in the past, when we do get below that minus 2%, it can get pretty ugly fast. -4, -6, -8. We don't generally stay down there for very long, right? We tend to flip around and come roaring back the other direction. We are 3.5% below the 10-week. Let's add a little bit of time to this so we get some context to that. 3.5% below the 10-week. We're not quite at the point that it begins drama. That's going to be closer to 4.5%. But, 3.5 is pretty negative. So we got about one more point to the downside. Our distance from the 10-week. After that, we would again consider this to be oversold, and that is where we can get flash crashes and things can get really nasty. We're not there. We're just getting close. What would really help with all of this is having a sideways day today where we stay inside of Monday's range. And if you remember, Monday's range is a really big bar. So if we wick out down below it, come back in, and then start this wild rip to the upside, that would settle all of this oversold talk. We got a lot of stuff that's red this morning, but when you use a benchmark of like 0.5%, there's a lot that's down, but not down enough. IPO, HYG, metals and mining, emerging markets, the KWEB constituents, uranium, banks, financials, generically. There's just a lot that is slightly negative or kind of negative, but not really negative. So on the one hand, that's kind of nice for us. We keep our eye on those and see if the selling accelerates across the board into the different sectors and industries. We look at what's up this morning. Junior gold miners, generic energy, and the Mag 7 down volume is up. And nat gas. Not a whole lot of joy in any of that. Not really helpful either. The good thing is if we do start to see the negative things turn around and start to get positive, these don't have to stop being positive. They can stay positive. The other stuff can come in and join them in that positive move. And then, we can get one of those positive bullish Fridays where we just keep going in a nasty grind higher and higher and higher. It would be a forced buying grind higher type of day. Those are not the funnest long trade opportunities, but market wise, they would certainly be better than breaking that Monday low and really expanding to the downside on a Friday. So, we got Bitcoin, Mag 7 up, volume is down, software, robots, generic tech, chips, solar, the Mag 7, bonds. It's not really that bad. If I was looking for a really good short day, I wouldn't be excited about it with these being my leaders to the downside. So sure, we've got some important ones like chips. Chips is important, and that's down. Software, we've got a couple that really matter that are down, but we'll see. Market breadth really hasn't had a lot of success dominating the market this week. It's been volatility and crude, commodities bullying the market, and market breadth has just kind of taken a back seat or held on for the ride rather than being the influencer. So why should today be any different? We've got our levels we need to break. Otherwise, the expectation is we stay inside of Monday's range, and we should be able to just hold the line and go into the close nice and quiet. Now, if we break Monday's low, we're still going to be looking for that reversal to bring it back in again. The measurement that I've got is 54. That's 64.54 and 64.21. And the ADR low for today, 64.09. So that fits, right? That's our regular move on a just a typical day. My mouse was a quitter. So if we do break our own Globex low, get below 64.83, target the ADR line below that. We got the 111, 1236, the full ADR. That should be as negative as we get. Flip it around, go back up. We get underneath that yellow line, and I think we're crash worthy at that point. We would certainly be in a heightened state of risk for a flash crash. On that wonderful sentiment, we'll wrap it up. Everybody, be careful today. Watch the clock. Keep your eye on the news. Sit on your hands if you have to, right? Just approach this market with caution. I hope you all have a good weekend. I'll see you next week.
Recording stopped.